There are thousands of videos on YouTube about options trading. Many of them are pretty advanced and require a lot of knowledge and investment experience. And if you are just starting your investment career, it's very easy to drown in all these terms. Long calls, covered calls, cash security puts, long puts, buy rights, long straddles, covered puts, protective puts, credit spreads, debit spreads, counter protective calls. Oh my god, stop, please. I know, I feel your pain, guys. Today, I will start from the easiest to learn and basic option trading strategy for beginners. It's called LEAPS. You should learn it first. In my next 10-15 videos about options trading, I will explain you other strategies as well. So consider subscribing and get new portions of new lessons and examples every week. I promise very soon you will be ready to use many strategies and grow your investment portfolio with option trading tricks and hints. Hi, my name is Dmitry Bonder. Hope you're doing well. Come for the investment and finance and stay because you want to learn options trading for beginners. I don't want to overwhelm you with the terminology, so to use this strategy and basically to understand LEAPS options trading, we have to find answers on 4 most important questions. What is a LEAP options trading? When should you use your LEAPS option trading strategy? When is it not the best idea to use LEAPS strategy? And how to buy and sell LEAPS, and let's say on a Webull or any other popular brokerage platform. So let the show begin. Okay, what is LEAPS option trading? Google tells me that LEAPS means long-term equity anticipation securities call. What is a call? Call options are financial contracts that give the option buyer the right, but not obligation, to buy a stock or bond. Now, what is a LEAPS call? LEAPS call options allow investors to benefit from potential rises in a specific stock while using less capital than purchasing shares with cash upfront. So in other words, the cost of premium for an option is lower than the cash needed to buy 100 shares outright. So similar to short-term call options, LEAPS call allow investors to exercise their options by purchasing shares of the underlying stocks at the strike price, any stocks you want. So options with more than 9 months until expiration are considered LEAPS. They behave just like other options, so don't let the term to confuse you. So it simply means that they have a long shelf life. Watch till the end. I will show you in my account on Webull how LEAPS works in practice, and smash the like button if you want me to make a new video about other options trading strategies. Okay, the next question. When should you use your LEAPS option trading strategy? When does it work? It works when you want to invest long term, when the expiration date is far from today. Just a quick explanation. One important difference between stocks and options is that stocks give you a small piece of ownership in a company, while options are just contracts that give you the right to buy or sell the stock at a specific price by a specific date. Option expiration date. But you may ask, what is the option's expiration date? It's just the day when the contract expired. Boom! If an option expires, nothing happens. No shares are assigned and the entire position expires worthless and disappears from the trader's account. And the second important reason and good moment when you should use LEAPS option trading strategy, when you anticipate a long bull run, let's say 1-3 years, and want to increase your profit significantly. The idea is to leverage your upside returns when you anticipate an upside movement, but you want to give yourself plenty of time. For instance, I just checked statistics. In March 2020, 2-year $300 call for S&P 500 was about $4. But at the end of 2020, the price of the contract was $28. So it's about a 600% increase. Now let's compare that with the actual price increase in SPY if we just buy shares of SPY at the bottom of March 2020. The bottom was $218 and at the end of 2020 it was about $287. So if I do 287 divided by 218, we get a 32% increase. So the 300 call option expiring in 2 years increased 600% from the market bottom versus 32% if we just buy SPY stocks. You may ask how that's possible. Because the volatility of options comes with more profit. Options trading is more risky way to invest than just buy and sell shares. The third reason why investors use LEAPS option trading strategy is because on the long run they limit their loss, but may have unlimited max profit. For example, let's make calculations. If a long call option with a strike price of $100 is purchased for $20, the maximum loss is defined at minus $2,000 and the profit potentially is unlimited if the stock continues to rise. However, the underlying stock must exceed $120 to realize the profit. So you see, there are many advantages to using LEAPS calls or LEAPS options trading strategy. But what about cons of LEAPS option trading? Well, there are some of them as well. So when is it not the best idea to use LEAPS strategy? First of all, it's important to remember that there are always two sides for every option transaction, a buyer and a seller. In other words, for every option purchased, there is always someone else selling it. Not every stock can be used for LEAPS strategy. For instance, Apple, SPY, Tesla, and other big popular companies, and they have a big volume of contracts. It's always very high. But LEAPS option trading strategy doesn't work very well if you want to deal with a mid-size or small-size unpopular companies. Also, in case of LEAPS, you may have some other cons. For instance, costlier premiums, long time frame ties up the investment dollars, prices are more sensitive to changes in volatility and interest rates. So please remember that premiums are the non-refundable costs associated with an options contract. And in case of the premiums for LEAPS, option trading premiums are higher than those for standard options in the same stock because further out expiration date gives the underlying assets more time to make a substantial move and for the investor to make a healthy profit. You will have more time to wait and stock can grow and grow. Also remember that the option contract has a basis of 100 shares of the asset. So if you decide to buy call options, let's say for Facebook, and let's say the premium for Facebook is $625, the option buyer will pay $625 total premium. And that's what you can lose very quickly. As with many other option contracts, investors pay premium upfront fee for the ability to buy or sell above or below the option strike price. So you always can lose this premium. And now, how does it work in practice? Let's say on Webull or on any other brokerage platforms. First of all, choose a stock. You should use exactly the same process you would use if you are purchasing the stock. Go to the Webull options menu and analyze stock fundamentals to make sure you like it. Now you need to pick your strike price. It's right there. You want to buy a LEAPS call that is deep in the money. When we are talking about a call, in the money means the strike price is below the current price. So it's right there below the money and it's in the money. A general rule of thumb to use while running this strategy is to look for a delta of 0.80 or more at the strike price you choose. Remember, a delta of 0.80 means that if the stock rises $1, then in theory the price of your option will rise 80 cents. If delta is 90, then if the stock rises $1, in the theory the options will rise for 90 cents. Where you can check your delta, just scroll to the right and you will see delta number. And you can see the far we are from the current date, the higher is delta. So in case, let's say, of March 22, the delta will be growing and growing and growing. And if we choose January 24, the delta could be even very close to 1. Look at this. Already heard that the phrase like in the money and out of the money, it's an option profitability. When the strike price of all call option is above the current price of the stock, the call is not profitable. In other words, an investor is not going to buy a stock at higher price, the strike, than the current market price of the stock. So when the call option strike price is below the stock price, it's considered in the money, since the investor can buy the stock for a lower price than in the current market. Okay, so it's time to act. As a starting point, consider a LEAPS call that is at least 20% of the stock price in the money. For example, if the underlying stock costs $100, buy a call with a strike price of $80 all over. However, for particularly volatile stocks, you may need to go deeper in the money to get the delta you are looking for. The deeper in the money you go, the more expensive your option will be. That's because it will have more intrinsic value. I will explain you this term a little bit later. But the benefit is that it will also have a higher delta, a higher probability, a higher return on your purchased contract. And the higher delta, the more your option will behave as a stock substitute. You must keep in mind that even long-term options have an expiration date. So if the stock shoots skyward the day after your option expires, it does you no good. Furthermore, as expiration approaches, options lose their value in accelerated rate. So pick your time frame very carefully. So choose any date that is very far from your current date. And as a general rule of thumb, consider buying a call that will not expire for at least a year or more. That makes this strategy a fine one for the long-term investor. After all, we are treating this strategy as an investment, not pure speculation. Now that you have chosen your strike price and months of expiration, you need to decide how many LEAPS call to buy. So, you should usually trade the same quantity of options at the number of shares you are accustomed to trading. So when you are buying, keep in mind that one contract means 100 shares. And if you typically buy 100 shares, buy one call. If you typically buy 200 shares, buy 200 calls. Don't go too crazy, because if your call options finish out of the money, you may lose your entire investment. And now that you have purchased your LEAPS call, it's time to play the waiting games. Just like when you're trading your stocks, you need to have a predefined price at which you'll be satisfied with your options, with your option gains, and get out of your position. You also need a predefined stop loss if the price of your options go down sharply. For example, you can use this option right there if you are buying and selling calls. And similar to short-term call options, LEAPS call allow investors to exercise the options by purchasing the shares of the underlying stock at the strike price. But just believe me, in 99% of cases, you will not be exercising your LEAP options. Thank you for watching this video, guys. I hope it wasn't very long, and I hope you now have a very clear understanding of LEAPS option strategy, one of the easiest for beginners who just want to start trade options on a Webull or Robinhood or wherever. As always, don't forget to smash the like button, subscribe, or follow my referral link in the description for Webull or Robinhood account and get a free stocks. Love you guys and bye!